Thank you for tuning into the Collecting Real Estate podcast. We focus on learning and teaching based on our guests' journeys operating their real estate investments and providing investment knowledge to passive investors so they can comfortably invest in multifamily real estate. Hey everyone, thanks for showing up at the Collecting Real Estate podcast. I have a very special guest today, all the way from Nashville, Tennessee. Tommy Brant from the TB Capital Group, self-proclaimed recovering electrical engineer. Tommy, thank you for being on the show. Please tell us about your real estate background, how you got into real estate.
Bill. Oh my gosh, is this the Bill Hamill? No, thank you so much for having me on here. Yeah, I'm excited to try to add some value to your listeners and keep it fun. So, but yeah, I'm based, like you said, I'm based out of the Nashville area. I think I'm still recovering from being an electrical engineer. Product support, sales, operations, and thankfully a lot of those skills transfer directly into being now a full-time real estate investor. And so, I think the question is, how did I get here? How did I get to this point is a fair question. And, I grew up probably similar to the narrative that your listeners have of, go to school, get good grades, get a good job, work till you're 65, and then, ride off into the sunset. And so I did just that. But I got into real estate kind of on accident. And it's kind of a fun story. But I was a sophomore in college, hungry for, a summer job, try to get some spending money. And I worked for a general contractor who was the primary contractor for someone that had one of the largest mobile home park imprints in Middle Georgia. So I grew up in Macon, Georgia, if you're familiar with there. So we serviced mobile homes pretty much anywhere within an hour radius of Macon. And so it's an interesting product, but about 15% of the product that we supported was, post eviction. So you can kind of imagine what that's like whenever you walk into some of these units that have been gone through eviction. There's trash everywhere. There's clothing, furniture, there's used diapers just thrown into the corner. The utilities have been cut off for weeks, and you're going to play the game of who's going to open the fridge, not it. And so, that Bill, that did two things for me, right? And the first one I would say is just, that built a lot of character, probably obviously. But the second thing that did is that gave me the ability to have the vision to know what the finished product looks like, regardless of what you see on the front end. And so that was also just a great experience for me, because after I graduated college, I graduated Georgia Tech, and got a couple years worth of savings. I'm 25 by this time, and this is 2011. And I bought a house, and it was a short sale. And it, my realtor probably thought I was crazy, but on paper it sounds great. So it was a 4-bed, 2-bath, attached garage, in-ground pool in the back with pool houses. And Bill, doesn't that sound great? But let's peel back some of the layers of that onion. So the pool was solid black. The pool houses had no foundation. We literally just pushed them over. They were 15-foot joists instead of 12-foot joists. So we had to resupport some of the foundation throughout some of the parts of the house. And then there was a leak over the garage. So there was a nice little bulge in the drywall ceiling there, and every square inch needed to be updated from 1979. And, I wanted a project. I'm mid-20s and I need an outlet of energy. And so I got a colleague from work to pay the mortgage. So I had a roommate, and then I was just saving up for big projects every year. And around year 3, I get a letter from the city that says, this is what we think your house is worth. Here's your new tax bill. Anyone that's owned a home for an extended period of time has gotten that letter, and I'm like, no, more taxes. And really, I had a couple fleeting thoughts, but I felt like every emotion on the end of the spectrum that you could. So on one end of the spectrum, I'm ecstatic, right? Because I'm like, okay, I'm justified in buying in this market and buying this house and doing all these repairs. And on the other end of the spectrum, I'm devastated, Bill, because like I said, the narrative that I grew up with of go to school, get good grades, get a good job, the impact that the equity that I gained in my house in a 3-year time period far exceeded, an engineer salary, take home bonus, 401k contribution and match and all that stuff. What I did in 3 years did more to impact my net worth than, the 25 years leading up to that. And so my foundation of reality was shook a little bit. And, after I read Rich Dad Poor Dad, then my whole, money mindset started to change. I started to rethink things that I thought were absolute truths. And then from there, I just started asking questions like, what's the difference between a person that makes $100,000 a year and $1 million a year? And we all know it's not time. And so, I started to ask questions of maybe I don't have to wait till I'm 65. Maybe I don't have to wait till I'm 55. What's it look like if I'm 45? And it just started, asking questions. And so fast forward, still grinding at work, constantly consuming education, habit engineering, networking, meetups, conferences, masterminds. And then fast forward to, now full-time in real estate, and I guess a portfolio of passively and actively invested 400 units, another 200 to be developed, and then the storage fund. So that's where I'm at today.
Fantastic. There's a lot going on there. What I really appreciate, based on what you asked yourself so many good questions, and I believe you probably gave yourself a lot of great answers, because here you are, you're a full-time real estate investor, and it's amazing. You're an engineer, and in 3 years getting into real estate, you just outperformed what you could have in that engineering business. Along with that eviction visualization, I had to laugh. I've been doing this a long time, and I must be a slow learner, because I still end up getting into those apartments. And why do I still open that refrigerator? I think I close it much quicker than I used to, but still that aroma perforates through that kitchen in a split second. So that's very interesting. Let's get into what you've done lately, or let's start off. What are your first real estate deals, and what has that led to till now?
Yeah, so I like most in this space, I started in the residential space. So 3 single family homes, bought off the MLS, probably analyzed close to 100 before I moved on any of them. So I had a really small buy box in one county that I lived in. And so getting focused really helped me out there. We don't have to spend a whole lot of time there, but after I got my feet wet, I had the right team members in place, and it was kind of autonomous. I thought I was going to be property manager, and it wasn't until I fired myself that we really started getting some traction in the business. And so we could talk about more the bigger stuff, the sexier stuff, just to give you a preview to our numbers. We looked at over 200 properties. We put out 70 offers. We were under contract on 2, and we closed on 1. And that's 2021 for me, in a nutshell. And it's, if you listen to Ken McElroy, his numbers aren't much different. He only did a handful of deals in this environment. And, my appetite for risk isn't, the same as the people that are overpaying for some of these properties, or maybe they just got lower cost of capital or accepting losses through 1031s. We can only speculate there. But, we could probably dive into the one that we canceled contract on, so that we can end on a high note, and I can share with the one that we did close.
That's a fantastic outline. Right before we get into that, you caught my ear on how you were able to fire yourself from property management. I was a hands-on property manager for over 25 years. It went from that first 2 family, wow, and then we just accumulated that portfolio, got into medium-sized properties, bigger properties, and I got deeper and deeper into the management business. Tell me why you fired yourself, so I can see why I didn't figure it out earlier.
For me, so there were a couple of things going on personally. So my wife still worked, and I still worked at the time. And so, we had it's more on the leasing side, right? Where I just didn't perform, and the debt service started to creep up and creep up and creep up. And I obviously have all these commitments for debt and expenses. And so it's really out of frustration that I just didn't perform the way that I wanted to. And so, but also keep in mind that I had just taken a new position about the same time that we had closed on new property. So I had to put in, 10 to 14-hour days just to kind of keep up with someone that had been in my role for 3 years. And so my plan I'm going to let all the voicemails and emails bubble up over lunch, and then I'll get to them then. People they're probably going into rentals for whoever answers the phone first. And I'm trying to schedule showings in the evenings, and that just doesn't work for a lot of other people's schedule that need a place to live now. So my schedule really wasn't conducive to me being the property manager and dropping everything to, handle a tenant issue or a toilet or a termite or, the 3 T's of property management there. So, it was bandwidth personally. So.
No, it makes sense. You got to keep your properties fully occupied. You can't pay the bills, or you're definitely not going to cash flow that way. Now, so I appreciate that. You're going to spend your time on needle moving items going forward. So let's talk about the deal that didn't happen. You mentioned that, and I've heard this too, you almost have to underwrite 80, 100 deals before you get one. And then sometimes we get one, we get excited, and we go through the due diligence, or somehow, some way that deal never got to the closing table. Let's talk about that.
For sure. Yeah, this one was pretty exciting. So just to preface that one, there was a broker relationship we've been super focused on and just kind of strengthening since 2021 actually. And it was paying off because, we were like playfully joking with some of the brokers in the firm. We're like, hey, do pocket listings exist? Like I've never gotten a pocket listing before. Like, and I hear about them. I hear that's how people get deals done, and this, that, and the other. And it was funny because a couple weeks later, we're about 9 weeks into just like attending all their meetups and asking softball questions whenever they interview people, and they really made it easy for us to support them, honestly. But we started to become top of mind, and so whenever they caught wind of an opportunity that was just 20 minutes outside my house. I was interested, one, just from a proximity perspective, but two, the seller wasn't wanting anything egregious. They struck me as the first seller that was like, hey, I'll sell for $1 million more than I bought it for, a year and a half ago. Let's, and if that works in today's debt environment, that does. But anyway, so we started looking at it. My partner and I, we were just underwriting. So we just give you a timeline because it's pretty funny. So we get the pocket listing on Sunday night. We underwrite it to heaven and back, by the time Tuesday comes, and then we talk to the broker about, what's the market doing, any new developments we can get excited about, that good to know. And they gave us everything that we asked for. And it started, checking all the boxes, right? Our healthy demographics, good median income, potential for rent pushes. And then we assembled a team around who we had a pretty good idea of who the strongest buyer was that also got wind of that pocket listing. And so, it's a small group of people in this space. And so we brought it to them, and they're, several years of experience. They were going to basically be the net worth liquidity experience, requirements that any lender would ever want and more. And so we brought it to him. We said, hey, here's our underwriting. Here's what's coming into the market. Here's blah, 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 blah. He's like, I think you're conservative here, here, and here, and here. I'm interested to be a part of the team. What do you need from me? We said, we need an asset manager. He's like, I know a guy. And so within short order, we'd assembled a team around this deal that we thought, had a lot of room to play in it, and had some LOIs and PSAs back and forth. And within a week, we were under contract. And so, there's not a formal, OM drafted for this type of stuff. And so we put in, a due diligence period, contingent upon stuff. We didn't have to do non-refundable earnest money day one, which was, refreshing, considering that just seemed like what you had to do in 2022 to get deals done in 2021. And so after that, the physical stuff was okay. Nothing had been changed for 2 years. The inspector that we had on site was the same inspector that inspected it 2 years ago when it transacted, and he was like, nothing's changed. It's the same. I could give you the 2-year-old inspection report and just color things a darker shade of red, and that would be applicable. And so, I started to wonder, like, did he have, a business plan? Found out that he did syndicate stuff. So I knew that he had commitments to investors and he probably couldn't move too much on his strike price for selling. And then it wasn't until that we got the updated accounts receivables that we started to really see the issue underlying there. Before I'm spoiling it a little bit, but before I get into there, the property management franchise out of Nashville hired a tenant to be a property manager on site.
Woo!
So that should be a red flag for any of your listeners there. And so they weren't auditing on the accounting stuff, on the bank recs that they should have been doing. And so eventually the property manager stopped paying rent, coached her roommates how to stop paying rent, word gets around. And so there for a 50 unit property, there were 6 figures of delinquency. And so that, very much destroyed the deal. And so from that point, we're like, okay, it wasn't nefarious, misrepresentation on the owner's side or anything like that. I say we, as in the buyer, the seller, the broker, all discovered this throughout being under contract. And so thankfully, like I said, we didn't have earnest money hard. And so it was refundable. It was given back, which was nice. But they had some work to do. They had some people to fire. They probably had some people to sue for failing in their fiduciary responsibilities. And so, but we honestly, we talked to them twice last year, and the second time that we talked to them 6 months later, they still hadn't fired the PM and things had gotten worse. And we're like, are you surprised? So it got to the point where I wouldn't even take over your loan.
Yeah.
Like it and nothing else. I wouldn't just do, a loan assumption for half the purchase price and be comfortable.
When this was presented to you, did they show you a rent roll and come across as a fully functional building, and you didn't realize that this was a sinking ship until you really dove into due diligence?
Yeah, and it was probably something that we could have put together based off of the T12. But yeah, the rent roll in a T12 can hide some stuff, but the accounts receivables is what will really show you the red flags when it comes to delinquencies. If I can, provide any sort of tutelage for your listeners. So yeah, T12 and rent roll is nice, but get the accounts receivable, see what the outstanding balance is. There should be a 30, 60, 90 plus day balance in the accounts receivables. And that's going to be way more telling, because a 30-day balance isn't going to be helpful because everyone's rent is due on the first. 60 days more interesting. 90 plus day is where the red flags are.
Yeah. So when we look at that rent roll, it really gives us a great overview of the property, the rents, lease expirations, how long someone's been at the property. And after one visit, maybe a couple visits, you really get a sense of whether the rents are under market or not, to see if we have that type of potential. And we'll talk a little bit about that T12. We're looking at month by month income and expenses, which is the overview on that T12. And we want that to tell us a story from January through December on how this property is operating, but that doesn't necessarily tell you the details when you got into that weeds on the age delinquency. Talk about those 3 reports a bit more, and that age delinquency is what really was the red flag.
Yeah, absolutely. The if you're underwriting any sort of deal, at a minimum, you need rent roll and T12, right? You need to know what their expenses are, but you also got to have in mind, what are your expenses day one? So your insurance is going to go up on day one. Your property taxes are going to go up, on day one. If you want to accrue that way, they may reassess every 4 years, like some counties in Tennessee, but just be mindful that their expenses are not your expenses. But it's a good guiding light. How much are they spending on marketing, contract services? If they're self-managing, then property management is 0, and you cannot afford 0% property manager unless you expect to also self-manage. But yeah, those are critical, right? That is your foundation of analyzing any sort of property. And if someone just provides you a shoebox of receipts, then you need to eventually try to build out what would be a T12 based off of those receipts. One, because that's going to be the first question any lender asks for. But two is like, that you have to get it in that type of format before you can even start underwriting and analyzing the property.
No,
Critical files for sure.
Absolutely. And if anybody is looking at an operating statement and it doesn't have a management fee in there and you're going to do the management, you still have to put a line item in that management, because we always have to think of the exit on any property. And when you're selling it to somebody else, they're going to put management and vacancy and an accurate repair and maintenance, or a very conservative repair and maintenance in their underwriting. And that's how they're going to come up with their offer. So when you found that red flag in the age delinquency, at that point, obviously it was, okay, a do or die moment. Did you consider going back to the seller and say, hey, clearly we aren't interested in moving forward at the proposed LOI? Did you try to get it for a lesser price, better terms, to at least try to keep the deal together?
Yeah, the options that we did consider were, obviously a price discount, but because they had syndicated, they couldn't move a whole lot on their strike price. The other one that was probably more obvious was we could do a master lease with option to buy. So we said, hey, we'll handle all these evictions for the next 6 to 9 months. Give us an option to buy in a year or 12 months or something like that. And there's a couple things to be mindful of whenever you're doing that. There's implied trust really from both parties on that. And we didn't know the owner, they didn't know us. And so that trust really wasn't built. But, and I say that because, we could be 3 months into, turning this property around, and, he would say, you know what, never mind, but thanks for cleaning my property up, sue me.
Yeah.
Take me to court. And so, or God forbid, he gets hit by a bus and it just rolls into the estate, and their kids are like, why would I want to sell this? Like, no way, this is a great asset and a great market. I'm moving to Nashville. I'll take care of it. But one, just estate court, it just a gray box that just it could float there for an indeterminate amount of time. The other thing to be mindful of is that if you're doing a master lease with option to buy, there's no formal transaction, financial transaction, and so we wouldn't have been able to take investor capital into doing that until we actually do close. And you could navigate that. You could say, I'll get a private construction loan or something like that. It's navigable. But it was really because we had no prior relationship with the owner that we just didn't really feel comfortable doing the master lease with option to buy.
Yeah, and it's almost the way that you were looking at it. You already had your team built, and you had a KP that was going to be able to qualify for that loan. So that master lease on this deal is almost a practice run, getting the operation straight so you could actually hit the ground running with your original business plan. So that may not have worked as far as what you guys were trying to do on this particular deal. So at that point, deal just fell apart as deals tend to.
Yeah. And like I said, we asked about every question you could to try to keep it alive. But, thank goodness we had veterans on the team. They're like you could think about where you're going to be 6 months from now. You're still going to be running waist high in the mud, or you could be in a new deal, and not having to worry about this type of stuff. And so thank goodness for their experience and mindfulness around that, to kind of help guide us, because that would have been my first syndication. And, I'll be nice and say that I probably would have learned a lot, just from setting myself up for almost failure on that one. But the master lease with option to buy, like that wouldn't have been a bad option if the delinquency wasn't so bad. There were, variables in that equation to come to that conclusion. So, if we didn't have, 6 months or 9 months worth of evictions to do, then we would have considered it more seriously. But, yeah.
Well, we're willing to take those projects on if the return metrics reflect, and if it's worth our what we call ROE, that return on effort. That's
Yep.
extremely important. This deal in Nashville, Tennessee?
Yeah, it was a submarket on the southeast side of Nashville,
Okay.
probably about a full hour outside of Nashville. But along if you're familiar, there's an interstate artery that just goes to the southeast. So it was along there, and that was kind of I'm going to give you a 10-second path of progress for Nashville, but anywhere on the south side is the path of progress for Nashville. If you just look at where the interstates are building out, you could probably guess.
Gotcha. And it's so beneficial. You had some people on your team that were able to provide some wisdom saying, hey, let's cut this line. Because what I've learned also is, the power of focus. Sometimes there's no use. You just cut the line. You don't have to focus on that anymore. And now you can focus on that next deal that is going to be fruitful, where you can take your team and start from scratch and execute that business model. Let's talk about that. Getting into that next deal. I know you have something going on there. Is it the same market? And what does that deal look like?
Yeah, and so we've been looking at markets, pretty much a 4-hour drive every direction except west. I don't have a lot of interest in Memphis, but that takes me from Louisville, Bowling Green, Clarksville, Kentucky, Nashville proper, down to Columbia, North Alabama, things like Huntsville, but also takes me to East Tennessee. So Chattanooga, Knoxville. So constantly just looking in those markets. I'd actually invested passively in Louisville. And so one of my peers reached out to me, said, hey, we're under contract, or it looks like we'll get under contract soon for a 49 unit in Louisville. And I think there's room on the team for you. And this was a guy that I'd been meeting weekly for over a year. We'd had a Sunday mastermind group. We joked that we started our week on Sunday nights, just kind of getting motivated, sharing there'd be a rotating speaker where we share, about our business, any lessons learned, market updates, that sort of thing. And so how they got the contract is, it really highlights the fact that there's power in the follow-up, because it was a 49 unit in Louisville, and they were not the best and highest offer. In fact, the deal had gone under contract and failed to close. And then the broker came back to, their second or third place and said, hey, are you still interested in this one? And we were in that. And so, but it wasn't based off of price. And so what we did was we said, all right, we can't meet your price, but we can, maybe can we go a little bit lower price with a loan assumption? And they took us up on that. And so we ended up executing a loan assumption on that one. And if you've never done a loan assumption before, just know that they will always get delayed. So put in your PSA to have the ability to buy extensions, for additional earnest money. And so, but that was good. So we went into this deal with 57% loan to value, interest rate in the 4s. We didn't put supplemental debt on top of it. We talked about that, but that makes it a more attractive cash flow play, low leverage cash flow play. It was on the lower end of the spectrum of returns that we like, in terms of annualized returns or internal rate of return, which was fine considering that we were probably on the brink of some economic uncertainty. So lower leverage was, where we decided to be. So, but yeah, so we closed on that in November of last year.
You have to fill that gap of that, 40% left to fill with equity investors. And when you have more equity investors than a debt investor, tell us about that. There's different dynamics that happen in the return metrics when it's set up that way.
For sure. Yeah, it was a $3.5 million purchase price, and the raise was 2.3.
Oh, wow.
So we literally raised over half the purchase price. So yeah, you're right. On paper, that
annual return and increases the cash on cash.
For sure. And if we're targeting 15 to 20% annualized return, 6 to 8% cash on cash return, and 14 to 17% internal rate of return, the overall project is going to be on the lower end of the return spectrum, but higher on the cash on cash spectrum. That's kind of the dynamic between leverage and returns there. But yeah, it's pretty interesting. Higher returns on paper could also constitute higher risk. And I think that the fact that we've got so much staying power in this property really kind of alludes to the fact that there's, it's a lower risk as far as the debt goes.
Let's talk about that team. Is it the same team that you had in that Nashville deal? And what's your position there?
Yeah, it's a slightly different team, and so really just a different group of guys. And so, but this is this gentleman that I guess, like I said, a couple of them I'd met, with weekly for over a year, and then another group I'd met at a conference and through them, here in Nashville, and come to find out that they've just been doubling down in Louisville like crazy. And so they've been, one of them fixing flips actively in Louisville, knows the street by street markets, knows which neighborhoods to be in, knows which there's, and generally speaking, if you're looking at Louisville on a map, the south side, if you're going further south away from downtown metro, the higher the median income gets.
Well, I'm just diving into that team. I really want to see the current team that you have, and if you're going to go forward, do more deals with that team, because we all know the value of a team, but we don't want to just jump into partnerships. It's so key to know, like, and trust each other, and to build those relationships. So you are building that all-star team, so you can go deal to deal.
For sure. Yeah. And I'm sorry, I need to back up on that. We had two people that are local to the market. So they were within 15 minutes of the property. So we had boots on the ground for that one, which I was really pleased about. And then we had the asset managers, which is, they're not local, but they had managed assets in Louisville already. So I think we had over 100 units altogether. 200 if you count the ones I'm passively invested in, but I kind of don't. I'm not actively in that one. So, but like I said, a team that was zeroed in on the Louisville market, knew the street by street really well, knew which vendors to take in, not take in, knew which property managers to avoid, which really it was helpful. Whenever you talk about how disruptive it is, whenever you have to replace a property manager, holy cow, that's on a multifamily property too.
Boy, is that a transition. Especially when you do it once. You don't want to do it twice. Boy, is it an inconvenience to the tenants, to everybody. It's a pain. So at this point, what are you looking at
now? So now, I still would consider stuff in the Louisville market. Nashville, we talked about this a little bit, Bill. Nashville is really freaking hot. not just temperature wise, it's only April right now, but there's a lot of speculation that this market has, 10 plus years left to grow. It's just like Austin was, people compared to Austin. And that, there's so much runway. So people are speculating on appreciation, and there's not a lot of stuff that's cash flowing, unless they're just bringing a lot to the table that I don't see. So we've started looking more in East Tennessee, but the secret's out in Chattanooga as well. But like I said, a lot of good, strong markets in Middle Tennessee, East Tennessee. Where we've started looking is on the north side of Atlanta, and then the north side of Georgia in general. So anything that takes you from Atlanta connecting to Tennessee or the Carolinas are stronger markets. So the strong secondary stuff is kind of what we're looking at primarily.
Sounds good. And then is it that same core team? You guys looking to build assets together?
Yeah. And the challenge, I think, in any syndication is that my top five of, people I want on a team, it changes by market. And so for Chattanooga, Knoxville, I'm probably going to have slightly different team members. They're definitely team members that I want in certain seats, the right seats on the bus type thing. But I'm probably going to have different key principals or, lead sponsors that are interested in those markets. And the deal size is going to affect who I can attract to, sponsor some of those deals when it comes to, lender requirements around experience and net worth, that sort of thing. And so there's definitely there's one or two core people that I want with me on every single deal. And then the key principal who's signing on the loan for experienced liquidity, that's, the deal is going to have to attract them, kind of thing. And so some parts are variable, but other parts are fixed for sure.
Yeah, and that's key. Having that key principal is great. You're able to qualify on that loan, but you mentioned the seats on the bus. What's your seat on the bus, and talk about how important it is for that team to have complementary skill sets.
Yeah, no kidding, Bill. I joke that I'm an engineer, and one of my strategic alliance partners is also an engineer. And so I think about that. I'm like, do we really complement each other? Are we bad partners? But he's detail oriented in a different way than I am. I'm more like organizationally oriented, where it's just like, let me make sure our file storage system makes sense, and we have, it, and I can replace myself, and there's instructions everywhere, and there's standard operating procedures. And he's more detail oriented in that, for a 1969 property, our repairs and maintenance, should look like this. If we have on-site tech, it should look like this. And so, like I said, detail oriented in different ways, thankfully. But yeah, my role in a lot of these deals is going to be primarily investor relations. And so on that Louisville deal, I was crafting a lot of the announcements going on with the property whenever we were going through the raise and the webinar announcements and the recordings. And so just kind of adding some flair to the marketing there, make sure it's not just a wall of text and boring, anything along those lines. Also review all the monthly communications that go out. Very involved with the asset management. So I was basically administered the K1 distributions for the last deal that we just did. And that was interesting to kind of go through that experience. But we have 2 calls a week, sometimes 3 calls a week just for one property. And that's, because we're in transition of a lot of things right now. And so I'd like to get to the point where it's 1 call a week, maybe 1 call every 2 weeks. But right now we came out of winter. So there's we're dealing with kind of the low lease up. And so we're doing crazy marketing efforts right now, and we're starting to see some traction from that. So that's pretty refreshing. But yeah. And, offering it's funny, the franchise for the property management is in Nashville while the local PM is in Louisville. And so I'm like, I will take you lock boxes or whatever you need. Like, let's not dally. So being semi boots on the ground is pretty helpful too.
Big question. How's that property manager doing?
Doing okay. We're ahead of schedule as far as the renovations are going. We had to kind of provide them some backups for some vendors. We've gone through a couple different plumbers, a couple different handymen. They haven't, performed to the way that we'd want it. They don't have the same sense of urgency that they have or that we have. And then the marketing is starting to become like an everyone, all hands on deck kind of thing, because, you can't stand to have, 85% vacancy for too long. So.
No, and I learned that too. If you think you're just going to pivot away from property management, be the asset manager, and think that the property manager is going to be the solution to all of the challenges, boy, are you wrong. So no different than those team members and those complementary skill sets. Same deal. Whatever you have to do to optimize and make that property run efficiently, if the property manager needs help, you better jump in. You're the general partner on that deal, and we have investors. Tommy, this is the Collecting Real Estate podcast, so we have a collection of questions for you. We're going to wrap this up. First one, in 5 words or less, what is the most important thing you've learned since collecting real estate?
I have 3 words for this one, but educate, network, and act.
Awesome.
And I'm happy to elaborate, but you got to get educated before anything, and you got to network with people to help assemble their team, and then you got to act, because there's education in the action.
Boom. Yeah. Without doing all of that and no action, we call that, what do we call that? Paralysis by analysis, and that gets us nowhere. The one thing I did notice when I looked at you on LinkedIn, networking, yeah, it's huge. I just did my monthly meetup last night, and I know that you host one as well. Awesome.
Yes, sir.
And how's that going for you? How long have you been doing it?
I co-hosted for the better part of a year, and then I took it over just because the existing host, he'd been doing it for long enough. So hosting it completely for, I think, 4 months or so. But we've been stuck in virtual land forever. So we just took it in person last month, actually. So a lot to celebrate in terms of getting back to normal.
Absolutely. Face-to-face is much more valuable than those Zooms. Even though we love the Zooms, if we want to connect with people nationwide, you can't be face-to-face, right? Second question for you. What are your 1 to 2 year personal goals?
Personally, I'd love to be in a position where I could retire my wife, and let her choose what she wants to do. Right. And it's just like, she's in a position now where she has to work. She doesn't get to work. And I would just really like to see her in a better position where she says, I get to go to work every day. I don't have to go to work every day.
Yeah, time freedom for everybody, isn't it? Jeez, there's so much value there. Last question for you. How can we assist you and how do we contact you?
For sure. Yeah. And, I want to preface this a little bit in that, there's been a lot of people that have given to me, right, at no expense or anything like that, and just poured knowledge and expertise and mentorship into me, and I really just want to give back. And so I wrote a book called The Passive Investor's Guide to the Multifamily Universe, and you can get that for free off my website. I'm not monetizing that, but check out tbcapitalgroup.com. Again, that's TB as in Tango Bravo capitalgroup.com. And then my contact information is on there as well if you hit the connect tab.
Awesome. I love that. You have that book that you wrote for that lead magnet. We can appreciate that. And what I'm looking at in Tommy's background right now is add value. So that's what he's doing at all times. Go to his website, tbcapitalgroup.com. Awesome. Thanks, Tommy. I appreciate you being on the show.
Thank you, Bill. I had a great time.
Awesome. Hey, everyone. If you enjoyed this episode, please give us a review and 5-star rating. This would be very helpful to us. It allows us to build momentum in the podcast world.